Thank you, Paul. I appreciate the warm welcome. And good afternoon, everyone. I look forward to spending more time with many of you in the coming weeks and months. It is a privilege to take my first earnings call as CFO. The Upstart team has built a highly differentiated AI-powered credit platform, and the runway in front of us is enormous. I take seriously my responsibility as the financial steward of this platform, including the discipline Paul described around treating equity as a real cost and running a capital-efficient business. I spend my first weeks here digging into the business and the plan, and Paul and I are fully aligned on our financial priorities. I look forward to updating you on our progress each quarter. Turning to Q1. Before I review the numbers, I'll provide some color around some of the factors Paul mentioned that were specific to the quarter and an expected part of our trajectory for the year. Starting with newer products, we continued to make progress growing our auto and home businesses and saw strong growth in superprime personal loan originations as well. This drove a sequential dip in our overall take rate and our contribution margin. Next is seasonality. At the top of the funnel, we typically see consumer demand for personal loans soften in Q1 as tax refunds reduce borrowing needs. This soft demand typically translates into lower conversion and a modest step down in contribution margin in Q1 versus Q4. Additionally, our business has OPEX seasonality in the first quarter of the year with a step up in corporate costs associated with our compensation and benefit cycle and the timing of our annual company-wide gathering. Finally, we made deliberate investments in talent in Q1. This sets us up to achieve our objectives for 2026 and beyond. Each of these factors, mix, seasonality, and investment, in addition to the platform and product gains Paul mentioned, was contemplated in the team's planning for the year. We are on track to deliver on our full-year guidance. Now, I'll walk through our Q1 results. Originations were $3.4 billion, up 61% from the prior year and 8% sequentially. Within this, total personal loan originations grew 6% relative to Q4, reflecting 26% sequential growth in superprime and better than typical seasonal performance in our core business, which was roughly flat sequentially relative to the historical Q1 step down. Our newer secured products continue to scale with auto originations up 32% sequentially and home up 16%. Taken together, these results demonstrate the strength of our core business and the growing contribution of our newer products to overall platform growth. Total revenue came in at approximately $308 million, up 44% year-on-year and 4% sequentially. This included revenue from fees of roughly $277 million, up 49% year-on-year and 4% sequentially, driven by growth in platform originations. Within fee revenues, servicing revenue continued to show solid growth of 52% year-over-year and 22% sequentially, driven primarily by higher origination volumes along with an increase in fees connected with the sale of loans. Net interest income and fair value adjustments totaled approximately $31 million, up modestly year-on-year and roughly flat with Q4. Our contribution profits, a non-GAAP metric defined as revenue from fees minus variable cost for borrower acquisition, verification, and servicing, was $137 million, up 34% year-over-year, but down 2% sequentially, primarily as a result of increased marketing investment to optimize digital channels and support new product growth. Contribution margin came in at 50%. Down 3 percentage points from the prior quarter, reflecting the mix, seasonality, and marketing investment dynamics. We expect contribution margin in Q1 will be the low point for the year, barring any changes to macroeconomic environments. In total, GAAP operating expenses $16 million in Q1, up 45% year-on-year and 14% sequentially. Variable expenses, borrower acquisition, verification, and servicing rose 68% year-on-year and 12% sequentially, with a step up versus Q4 reflecting marketing investments. Fixed expenses were up 31% year-over-year and 15% sequentially, reflecting the beginning of year investment and seasonal step-up corporate costs I discussed earlier. I'll note that our fixed cost investments for the year were front-loaded into Q1 and we expect more modest sequential growth for the remainder of 2026. This sets us up for the adjusted EBITDA margin acceleration we've guided to as the year progresses. In Q1, we had a net loss of approximately 7 million. GAAP earnings per share was -7 based on a diluted weighted average share count of 97 million. Adjusted EBITDA was roughly 40 million with a margin of 13%. With this quarter's results, we are on track to deliver on our adjusted EBITDA outlook of 294 million for the year and to be solidly profitable on a GAAP basis. We ended Q1 with just over 1 billion in loans held on our balance sheet, up approximately 30 million from Q4. It continues to be our strategy to primarily rely on third-party capital to fund our growing originations. Notably, our secured products and other R&D loan balance declined modestly quarter-over-quarter, even as auto and home originations accelerated. More broadly speaking, as Paul mentioned, and supported by consistent credit performance, we've continued to enhance our capital platform. So far this year, we've signed more than 4 billion in committed capital partnerships, completed 2 securitizations for 1 billion in total collaterals, and increased the proportion of home and auto loans funded by third parties. Additionally, in February, we bought back 3.22 million shares of Upstart stock for 100 million and we have about 122 million remaining under our current authorization. Looking ahead, we are reiterating our full-year guidance. This means that for full year 2026, we continue to expect total revenues of approximately 1.44 billion, revenue from fees of approximately 1.3 billion, adjusted EBITDA of approximately 294 million, which equates to approximately 21% of total revenues and consistent with our prior guidance. Our guidance assumes a stable macroeconomic backdrop. Additionally, I'll share some color on the drivers and the shape of the year. First, for the full year, we continue to expect growth in absolute contribution profit dollars to be within at least 5 percentage points of fee revenue growth. We plan to deliver this profit growth using 2 complementary levers. Growing our core personal loan business where margins are already strong and continuing to improve unit economics on auto and home as they scale. Second, marketing and OPEX growth should moderate in the remainder of the year relative to what we saw sequentially in Q1. Third, we continue to expect adjusted EBITDA to be weighted toward the second half of the year, driven by originations growth, improved contribution margin, and OPEX leverage as we progress through the year. To close, our performance in Q1 was right on track. We enter Q2 with momentum across our core business and our newer products, with consistent credit performance and with a reinforced capital base. I also want to thank Paul, Sanjay, and the whole team for their support and partnership as I come up to speed. With that, I'd like to turn it over to the operator to begin Q&A.